Out of thousands of stocks to choose from, investors use valuation measures like the PE ratio to figure out which stock is actually worth buying. Keep watching this video to know how to correctly use this PE ratio to figure out which stock to buy, and then using those ratios to find out what price to pay for those stocks. Hi guys, I hope you're all doing well. So valuation measures or metrics, they are absolutely necessary to figure out whether a company stock is worth buying. They really help us to put a number on the value of the stock before we go ahead to buy it based on the current market price. There are multiple of these valuation metrics, but one of the most popular one is called the PE ratio or price to earnings ratio. Remember that any stocks which are publicly traded has two prices. One is the observable market price that you see of the stock, and the second is the true intrinsic price of that stock. A company's market stock price will time to time deviate from its true price. When a company's price is below, it makes the stock look cheap, and so it becomes a buying opportunity. So what is this PE ratio? P is the current market price of the stock. E here stands for earnings per share. You get this number by dividing the company's total earnings by the number of shares it made available to investors to buy. You can get this earnings number very easily from a company's financial statement. Let's take Amazon for example. This is their quarterly financial statement. These numbers reflect Q4 2020 finances, or the last quarter of 2020. We can see that Amazon's basic EPS or earnings per share was $14.38 in Q4 2020. So we can use this number in calculating the PE ratio. But make sure that you don't just pick the most recent quarter's EPS number and divide it by the current market price. Quarterly EPS number will only reflect 3 months of Amazon's earnings, while by convention we have to use the company's 12 months total earnings. And this brings me to the first point around calculating the PE number. There are two main types of PE ratios, trailing and forward PE. Trailing PE ratio will look back over the last 12 months of earnings, while forward PE ratio will look over the next 12 months of earnings as estimated by the financial analyst. So going back to Amazon, let's pick the company's last 12 months EPS number so that we can calculate its trailing 12 months PE ratio. So in Q4 2020, it was 1438, Q3 2020, it was 1263, Q2 2020, it was 1050, and Q1 2020, it was 509. Observing online, we can see that the Amazon stock price is usually around $3,000 per share. So let's add up all the quarterly EPS number to give us a 12 months EPS of $42.60. Now divide $3,000 because that's the stock price, and we get a PE ratio equal to 70.4. This means that based on how profitable Amazon was over the last 12 months, you are currently paying 70 times that amount to buy a single share of this company stock. Let's double check our calculation on Yahoo Finance, and yep, the number matches. Compared to the trailing figure, if you think that Amazon is likely to perform differently in the future, you can also look into their forward earnings number. These are estimates based on guidance from the company and financial analyst forecast. This is something many retail investors may not be able to get hold of themselves because analyst estimates are not available for free. Well, of course. However, if you really want to do some projection yourself, you can use a combination of last 12 months EPS number and do some qualitative reading at your site to come up with a judgment around how the company is likely to perform in the future. Okay, now that we have this number, how should we actually go about to use it? Here is a catch that you should be mindful of when you're using PE ratios. Firstly, if you have already done a lot of background research on a company and you know that you want to buy it at some point and you are simply just waiting for the right opportunity to buy, then compare the current PE ratio of the company against the company's very long-term average PE ratio. What I mean is that look back over the last 10 years of PE ratio and take a simple average around it and see how that number compares to the current number. As this is calculation heavy, you can use websites like Macro Trends or White Chart to see these numbers. For example, I can see that the average PE over last 5 years for Amazon was 155. And purely based on that, we can say Amazon looks undervalued versus its 5 years of history. Remember, lower the number, cheaper it is on a relative terms. And the second way to correctly use the PE ratio is by comparing it to the company's competitors or peers. This will tell you whether the stock is better valued against others. As an example, let's bring in Alibaba, which you may see as a comparable investment option to Amazon. In Y chart, we can see that Baba's PE ratio is 27.6. According to this, keeping all else equal, it shows to me that Baba is way better valued compared to Amazon. You can do the same comparison by looking at values against the whole benchmark or a sector benchmark. So sticking to S&P 500, let's see how Amazon compares to it. We can see that S&P 500 is currently trading with a PE ratio of 34. So by comparison, Amazon looks expensive versus the market. But a big caveat here. Simply comparing Amazon to the overall market will always make Amazon look expensive because it is a growth company. So make sure that you compare it to something that actually makes sense, such as the industry that it operates in, which is consumer discretionary. Finding a PE ratio of a specific sector for free would be really hard for people to get hold of. So in that case, I would suggest you compare the Amazon PE to its competitors like one by one and figure out how it fares overall. However, if you are really up for calculating a sector PE yourself, you can also do that. But I'll leave that calculation for another time because it is not as simple as taking an average of all the stocks that operates or falls under the certain sector. So this brings me to a really important question of what price should you pay for a company stock using a PE ratio. Say that while looking at past 10 years of PE for company X, you realize that on average, going forward, the company should maintain their PE ratio at 30. The company's current stock price is £100 and its recent 12 months trailing EPS is £2. This gives us a current ratio of company PE at 50. And this means that the company is currently overvalued since 50 is above 30. But until what price will it remain overvalued? You can simply rearrange the formula to say what should be the P when I multiply EPS by 30. If you multiply 2 by 30, we get £60. So you should be observing for stock price to adjust downwards closer to £60. Personally, when I try to back out the true price of a company stock, I prefer to use my own EPS number, which is based on analyst forecast and also a bit of my judgment. Say that the analyst forecast EPS for the stock is £3 versus the £2 that it is currently trading at. And if I think that the analysts so far have overestimated the company's earnings, I would therefore try to bring down the forward EPS to a number, say £2.50. Then I get 30 times 2.5 as £75. This is the price I would be looking to buy at. Before we end this video, I wanted to point out a very important thing that you should always remember when using PE ratios. And that is the fact that PE ratios are not suitable for emerging growth companies or companies that are highly growing at the moment, because typically these companies, they don't have a positive earnings figure or their EPS number is more likely to be negative, and using a negative PE ratio, well, it doesn't really make sense. Also, PE ratios are not the best measure for companies like banks because they are better reflected using a different types of valuation metrics, which is the PB ratio or price to book value. Basically, there are so many different types of valuation measures out there, such as price to book, price to sell, price to cash flow, price to earnings growth. And those may be better suited for the type of company that you're analyzing for investment. That's all for today, guys. I hope you found this video useful, and until next time, look after yourself and your money.